Big headline today. The Federal Reserve is cutting its key rate. But what does that really mean for you? I'm Professor Punzworth, bow-tie bright and brain tight. Let's untangle the federal funds rate and see how today's cut ripples through the economy. The federal funds rate is the interest banks charge each other for overnight loans. It's basically the baseline cost of money. When the Fed raises this rate, borrowing gets pricier. Spending slows and inflation cools down like soup off a stove. When the Fed lowers this rate, borrowing gets cheaper, spending grows, and the economy speeds up like a car hitting the gas. Today, the Fed lowered its rate by 0.25%. That tiny adjustment ripples through mortgages, car loans, and credit cards. If you're buying a house, lower rates can mean smaller monthly mortgage payments. That saves families thousands over time. If you're financing a car, the rate cut may shave dollars off bills, making borrowing feel less bumpy on your budget. If you're carrying credit card debt, the change can slowly reduce how much interest piles up, giving your wallet some relief. But savers may sigh. Lower rates usually mean banks pay less interest on savings accounts and CDs. Not great for piggy banks. Small businesses feel these changes too. Cheaper loans can help shops expand, hire more workers, or buy new equipment, boosting local economies everywhere. Students notice as well. If you have variable student loans, cuts can reduce payments and give graduates more breathing room. Even the stock market pays attention. Lower borrowing costs can lift company profits. That often boosts share prices, though markets still worry about inflation risk. And don't forget global effects. Other countries watch America's rates closely. When the Fed cuts, dollars may weaken, changing trade flows and investments worldwide. Everyday families feel ripple effects at grocery stores. Cheaper borrowing may help businesses expand, but inflation risk can push food prices higher again. Gas prices shift indirectly too. If global demand rises with cheaper credit, oil becomes pricier. Drivers may feel the pinch at the pump. Retirement savers notice as well. Lower rates mean savings accounts and bonds pay less, but stocks may climb, helping portfolios grow differently. The Fed's goal is balance. Cut too much and inflation climbs again. Cut too little and growth slows. It's a careful tightrope. Remember the difference. Federal tax rates are about how much you owe. Uncle Sam, federal funds rates are about loans and credit. Quiz time. Let's test what you've learned today. Ready? Here we go. Question 1. What is the federal funds rate answer? It's the short-term interest rate. Banks charge each other for loans. It shapes borrowing costs throughout the economy. Question 2. What danger can happen if the Fed cuts interest rates too much? Think carefully about prices. Answer. Inflation could return, meaning prices rise too quickly for families and businesses to keep up. Classroom discussion question: if you were running the Federal Reserve, would you cut rates today, raise them, or keep them steady? And finally, if you enjoyed today's curious current event, hit subscribe and join me again, where learning is always a valuable investment.